Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer and today we're going to be analyzing Chevron stock, and it's going to be sort of a double analysis. I'm going to look at it from the point of view of it as a deep cyclical stock and a deep cyclical business. And then I'm also going to look at it from the perspective of a dividend investor who's just focused on the dividend income that they could potentially collect from Chevron over time. Chevron, because its earnings can be quite cyclical, but it also has a very long and steady track record of producing, of recovering from those earnings declines and producing good dividends. It makes it a pretty good stock to look at from that perspective as well. My preferred way to look at it is from the cyclical perspective, as the Cyclical Investors Club might imply. But I definitely have a dividend strategy. It's hard to find stocks that are cheap enough with that strategy now, but I can tell everybody how to look at them from that perspective and the prices where they would be attractive. As always, this isn't individual investing advice. This is just how I analyze stocks. So Chevron came in as a request down in the comment section of one of my other videos. If you have a stock that you would like me to analyze on the channel, just put it down in the comments. I will get the ticker on the whiteboard that's behind me, and eventually I will make a video. If it's a stock that's in the S&P 500 like Chevron, I post those on YouTube for free. The rest I post on Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. Those links will be in the description. And over in the full service, I have all the strategies that I use, not just the ones that I share publicly. I have portfolio you get to see what I'm actually buying, what I actually hold. You can go back in history and look at everything since 2019 that we've bought and sold. You can look at the performance of that. You can interact with me directly, send me direct messages. You get access to all the explanations of my strategies, hundreds of articles that I've written in the past. I think I'm up to 500 on Seeking Alpha now. And so you get lots of benefits there. And so if you join Patreon, you can get a big discount to the full Cyclical Investors Club service if you ever decide to join there. Also, I'm going to use fast graphs a lot. I'm going to use some of the features that I don't use quite as much. I also have a 25% off discount code for fast graphs down in the description as well, if you're interested in that. So, all right, Chevron. Chevron's an interesting one. Popular stock. I don't know if I've ever written on it before. Maybe. I think in 2016. It was a long time ago. It's been a while, I think, since I've written on it, that I can remember anyway. Because the oil stocks are really difficult to analyze. We've had a lot going on. First there was the fracking boom. Then there was the bust of that when Saudi Arabia started pumping like tons of oil. Then we had somewhat of a recovery from that, but not a full recovery. And then we had COVID, and then we had a giant boom after that. So you can see all that in this earnings chart here, which is this dark green kind of shaded area. And what that does is it produces, and not to mention just the economy has changed and gone up and down, and all these things can happen at different times. So you can have an energy price spike even when the economy is not doing great, like say 2012 or something like that. Or in one part of the country, when China was really industrializing in that period, energy prices were higher. But so the economy there was demanding things, but that doesn't necessarily mean that the economy in another place wasn't being hurt by the high energy prices and so on. So it's all there's enough moving parts that it's basically pretty hard to predict. And it makes it hard to invest in. But usually I found if you can buy these when they're cheap, then someday they'll recover. If you get a big one and a good one, kind of like Chevron. In the 80s, these guys went through a down cycle like no other. I mean, I used to work at gas prices and everything and oil prices fell in the 1980s from the big peaks in the 70s with the embargoes and all that stuff. Or the, not embargo, but the oil control from the Mideast. I'm trying to think of the word and it's escaping me right now. But I worked at a gas station in the late 90s, and there was one point in time where gas was less than $1 a gallon. And this isn't like back in the 1960s or whatever. People would complain because the gas pumps they would say your gas pumps are running so slow. Well, they were watching the price, and the price was going up so slowly that the gallons weren't going slowly, but they were so used to paying higher prices. People actually were inadvertently complaining because the gas price was too low, which is very funny. So these can go through big, long phases, and they're hard to predict. So I'm usually pretty careful with them. But they can also offset a portfolio. I talked about this in my Occidental video, but they can really help balance a portfolio if there is an energy price spike, because a lot of other businesses are going to get hurt when energy prices are high. And generally, people's standard of living is going to get hurt when oil prices are high. Putting aside all the externalities and things like that, just the immediate effect is everything costs more money. So if you're not one of the people that is owning the oil during the oil in that process during that time, you're going to get hurt. So it's nice to have some energy exposure, right, to kind of balance out that potential outcome. And at this stage of the game, I mean, it's definitely a potential outcome. The U.S. is making tons of oil right now. But if there was a disruption or anything here in the U.S., and then a lot of countries aren't as fortunate as the U.S. To have a domestic oil supply. So things could definitely spike up from here. I don't think oil prices are excessively expensive or anything. And it could be a good idea to add a few to these or hold a few of these in one's portfolio. So that's my kind of big picture oil thing. But what we can see here with these earnings are they are very cyclical. So when Chevron looked cheap at a 10 PE here, they really weren't cheap. The price kept falling down lower, and when the price was, when the PE was like 33, well, that was a decent time to buy Chevron. Then, you get 10% return or whatever, annual return. So these PEs, because the earnings fluctuate so much, they can be quite deceiving, right? They can look quite cheap right before a big sell-off, and then they can look expensive during the trough of the cycles, right? So down in this COVID trough, the PE was 80. This is when I was actually buying. I didn't buy Chevron, but I bought a bunch of refiners like right here. So Chevron's PE was 95. If a person just looked at that and they looked at the PE, it would look expensive, but it wasn't expensive because those earnings were about to jump 4,000%, right? So this is why earnings, you just don't look at them really. You want to make sure that each cycle, the earnings peaks are higher generally. This was kind of a dangerous down cycle, but it had started to recover before COVID hit. So, and this was the fracking bust, pretty much. Like I said, these cycles can be quite long. They can also be very quick and short. I mean, it's really hard to predict, but you kind of know they're going to happen, right? So you shouldn't be surprised. And really, the way I approach these is I want to buy if they have a good history of generally rising earnings over time, bouncing back from their down cycles in a reasonable amount of time. Then you can try to buy these near the bottom of the cycle. So what I try to do is measure from the top down. So, and see how far they've fallen off the top in the past. So if we look at, I don't know how precise these are. I do these pretty quick right here. This is just my notes as a rough guide. But in 2001, like a 50% drawdown, it really wasn't too expensive. Like I said, gas was pretty cheap in the late 90s. So the peak on this one wasn't very cheap. It only fell 59 or 50% during that drawdown. Then 2008, when the economy collapsed, it fell nearly 70% off its high. And in 2020, we have a 60% drawdown off its high. So when I look at those, and I do other calculations to make sure it recovers in a reasonable amount of time. And if they do all that, then I follow them and I track them, and they're high enough quality that I would buy them. So using the quick and straightforward version here, when you look at this, you say, well, if I bought during 50% off of each one of these major declines, I would have captured every single one of the declines. I wouldn't have missed any major decline. And I could have, when the stock recovered to the old highs, I would have made 100% at least each time. So for a stock like this, which is actually pretty similar to the average kind of cyclical business, I usually do aim, the most common one, it's based on each individual stock history and earnings history, but the standard usually is you buy after a 50% decline off the high if it's not like a super cycle or anything crazy. And then I take profits when you reach a new high or when you get close to the old highs. And the thinking behind that is the market was willing to pay that price at one time before. So I know that under the right conditions, the market will be willing to pay that price again. So even though conditions are always changing a little bit, generally speaking, human beings behave similarly as they've behaved in the past. So if you have a higher quality one that you're pretty sure is going to recover, that has a good recovery history, it's never easy money because things are always scary when they're cut in half off their highs, and you have to have cash to buy then at that point as well. So it can be difficult to have that cash ready. But when stocks like Chevron do eventually, hit, then usually they're not too hard to buy. I chose not to buy it in 2020, and I went with the refiners instead. But and they cover kind of everything, and I wanted that more pure refiner play. So I didn't buy it, but it did reach reasonable buy price. It's possible I could have looked at this past 2 cycles here and said, like a 65% high. Or 65% off the high might have been where I was aiming, and it only got to 60. That's possible too, because I was pretty negative on what could potentially happen when the whole world shut down or whatever, when it came to like energy usage. And oil was negative at one point, right? They couldn't give us stuff away for a couple of days. So when you go through this process, then you just look and you say, okay, well, where would it be 50% off the high? And that's about $95 a share, so about 38% lower than it is now. So this would kind of be I would be buying probably, unless something really crazy was happening around this price. And then I would hold until it doubled, and hopefully I usually try to buy the stocks that will double in 5 years or less. And the sooner it doubles, the more money I make. So sometimes you have to wait. Sometimes a recession can come on top of whatever's going on. Something can delay a recovery. There's lots of stuff that can delay, and that you might get 100%, but the question is, how long will it take you to get to get that 100%? And that's just left up to fate to decide. So that's my simple deep cyclical strategy for Chevron. Now let's get into the dividend analysis, which I'm sure people are anxious. So the dividend analysis takes a different view. It says, okay, Chevron's been able to pay these dividends for a long time. They'll probably prioritize paying them. Even if they had to borrow money to pay them, they have a AA- credit rating, so they could probably borrow as much as they needed for a while at least, during a rough patch. So there's a big incentive that they'll probably keep paying these dividends. And I'm not like primarily a dividend investor, but I try to create strategies that are the best version of whatever people want. So if people want to focus mostly on the income, maybe they find that easier or whatever, I have a strategy for them. So if we look at the way I do this is I say, okay, I don't care about the price because I don't want to get scared during one of these down cycles and sell. I'm going to look at the dividend. I'm going to let that guide me. And I want that dividend to be, to provide a good dividend and dividend growth, a good return over time. The way I like to frame this is, because the future is difficult to know a long way into the future, 20 years into the future, 30 years into the future, it's a little easier to get an estimate 10 years into the future, maybe even 12 years into the future. We do have disrupting things like EVs and hydrogen technology. There's other technologies out there other than oil and gas. So, and we don't know what it's going to look like. So you want to be careful at the very basic level. You want to be able to earn your money back that you put into the business. And so what I like to ask myself is, if I really only cared about the dividend and dividend growth, how long would it take me to earn my investment back? If I bought $100, I bought this company for $100, how many years would it take the dividend to pay me back? So in order to do that, we need to know the starting yield of the dividend, which is 4.22% according to FastGraphs right now. I don't know if they're using forward or if they're using just what we already know. And then we want to know how much the dividend will grow. Well, the best way, or one of the ways, or a way to do that is to look and see what they've been doing recently in the recent past. Let's go back 10 years to 2013. Okay, so we get a full decade and see what the dividend growth rate was. So I just did this a little while ago and it was actually a little, oh yeah, here's the problem. I went back one more year. Okay. So we have 10 years of dividends. The average growth rate was compounded was 4.93%. So that's the dividend growth rate. So if you start out with a 4% yield, I'll get to my spreadsheet here in just a second, and that grows over time. If you paid $100 and you get $4, let's see what the actual. Are we on the dividend? Yeah, we are. Okay. So that was probably a forward-looking dividend from FastGraphs. So this is what they've actually did last year. And then I'm going to pull forward the growth when I start counting here in just a bit. So I might be a little bit closer to that 4.22% dividend yield when I actually start this. But right now I have the dividend yield at 3.97%, and I have the dividend growth rate at 4.93%. Now, often I will use an earnings growth rate too, and I use both the earnings growth rate and the dividend growth rate to try to forecast the future dividend growth rate potential. Because this is a deep cyclical and earnings fluctuate all over the place, I mean, that's pretty much impossible to do. So I'm just taking the 10-year dividend growth rate that they've been doing, and I'm going to assume that they can do something close to that in the future. So we're going with this 4.93% dividend growth rate. Now, let me go forward here just a little bit. All right. As I said, I like to pull forward that first year. So I'm almost up now to the fast graph at $4.17 on $100. So this is what you would get for the dividend that first year, okay? Including based on last year's dividend and the expected dividend growth rate. So then we go, and this is the next year, and this is the next year, and this is what each year's payout is. And what I want to know is, how long does it take all these to add up to $100? And so I have a spreadsheet that figures that out for me. And you can see I start this at 5 years here. So you can see how the $100 is building over time. Here's 12 years, right? And so that keeps going until this gets to $200. And at that point, I've earned my money back, and we're at like 17 years. So, and that's what's displayed right here. So it would take 17 years with the assumptions that I have here, and buying at Chevron's price today and dividend yield today of about 4% to earn enough dividends to pay back your initial purchase price of Chevron. That to me, well, first of all, I'll say this is kind of in a hold rate. I would call this like a hold. Over 20 years to me is probably based just on the dividend would be a sell in most cases. And then as a buy for me, like I'm pretty cheap, so I like to get my money back more quickly. I mean, the quicker you get your money back, it compounds faster. I mean, I like to get it back in 10 years. If you think about that, if you got it back in 10 years and you were able to reinvest it again in a similar situation, now you have a quadruple in 20 years. Whereas if you get Chevron, which is, you would just barely be getting into a double in 20 years. So getting your money back quickly really has a compounding effect that I don't think a lot of people realize. Now, in today's environment, if this was at like 12%, I made a video on Pfizer, or I wrote an article on Pfizer too recently where I did a dividend analysis like this, and it was at 12 years. I could be talked into or convinced by somebody that was really into like dividends and dividend investing that 12 years is okay right now. A 60-40, which is what I use to compare these up here, would take about 20 years with the estimates that I have. So 17 is quicker than 20. It's not that much quicker, but 12 is significantly quicker. So while there's other risks and things that come along, with buying cheaper stocks usually, the reward is you get a lot more compounding time for your money. You get your return of your capital back more quickly, and that lowers risk in a variety of ways. So there's lots of different ways to look at it. Now, when you use the 10-year return threshold, getting all your money back by the dividend in 10 years, that's about a $79 buy price. If you go with the 12 years, that's a lot closer to my 50%, like my $95. So that mostly things seem to be pointing toward that $95 number, and that's probably where I would aim to buy the stock. Just generally speaking, if somebody was, chatting with me about what's a good level that has a good chance of actually potentially happening. Probably I haven't checked this, but I'm going to say it wasn't too long ago that these guys were probably at 95. So let's see. Let's shorten this up a little bit so we can see each year. So in 2021, they got down to 83 at one point. I'm not sure if that was the beginning of the year, maybe. Yeah, so it's been a couple years, but they were down there. So it does happen. The stock really isn't that much higher than that. Like I said, it only needs to fall like 38% or something. So, which that sounds like a lot to some people, but it's not a lot for a cyclical. I showed you they've drawn down 69, 60, 50. So it would probably take some kind of event for that to happen, but it could certainly happen. Now, for the pure income investor who's really just wanting the income, you can get short-term treasuries for, I think T-Flow is at 5.4% right now, so that's actually better than 4.22%. Although, one of the benefits of owning a stock is that they can potentially raise their prices. The benefit of owning an energy stock is they can protect your portfolio more against an energy price spike, which would hurt a lot of the rest of your portfolio. So there's definitely trade-offs and benefits. I think if I own Chevron, I would be just holding it. It would just be in my portfolio. I'd probably be not paying too much attention to it. I think it's a little on the expensive side, but not compared to anything else you want to compare it to. The regular stock market, 60-40 or something like that. Pretty similar to cash, and you get different kind of benefits. So yeah, if you want to get good returns, that 95 or at least under $100 is probably where I would aim. And then if you already own it, then it's probably just a hold. All right, if you found this useful, hit the subscribe button. And if you have a request, drop it in the comments. If you liked it, hit the like button. And I'll see everybody later. Bye.